Yes, we can see.
Okay, fine. We move to the. Let's do a recap of our last class. Let's do a recap for like 10 minutes. Our last class, we discussed what is capital structure. The capital structure is the financial structure. The capital structure shows how a company is being financed. If you pick a statement of financial position, we have the assets. Under the assets, you have the non-current assets, the current assets, you have the total assets, you now have the current liabilities, you now have capital and reserves. How the business is being financed. What we are discussing tonight is that aspect of the balance sheet that shows how a company is being financed. Generally, a company may be financed by equity or a combination of equity and debt. Generally, a company may finance its business with equity capital only. In that case, that company will be regarded as an ungeared company, where a company is financed by equity capital only. We are going to regard that company as an ungeared company. Alternatively, if a company is financed by equity and debt, such company will be classified as geared company. We discussed this last week. We now look at it. The risk involved in financing. Is there any risk involved if you finance your business with equity capital? Or you finance your business with debt capital? Obviously, there is risk involved. We discussed this under the systematic risk, unsystematic risk, systematic risk, risk that cannot be avoided, risk that cannot be diversified away. Unsystematic risk, risk that is unique to individual investments. Such risk can be reduced or eliminated through diversification. We now discuss business risk, financial risk. Your business risk. Risk that has to do with the nature of your business. This is the risk that a company may achieve low profits, or the company may incur losses as a result of the nature of the company's business. Financial risk. additional risk to the shareholders, additional risk to the owners of the company. Who are the owners? The shareholders. That arises because the capital structure contains element of debt financing. In other words, financial risk has to do with borrowing, debt financing. We explain the beta. The beta is an index that measures the level of systematic risk. We discuss equity beta, asset beta, and debt beta. We try to explain factors that can affect your beta value, the nature of your business. The nature of your business defines your business risk. Your financial leverage. Your financial leverage defines your financial risk. Your operating leverage. Your operating leverage measures the extent to which your nature of business can affect your operating profits. To what extent is your nature of business can have impact on the changes in your operating profits. We discussed this. We equally discussed gearing. Gearing is the percentage of debt finance relative to equity financing. Your gearing, the extent to which a company has borrowed money. The gearing ratio measures the extent of borrowed fund in the company's capital structure. Why are we concerned with gearing, really? Why should the company bother about gearing? Yes, Usman.
Good evening, sir.
Yeah.
Hello, sir. Yes, sir. Sir, I just want you to throw more light on this equity beta and the other beta. I didn't quite get it.
Okay. I'm doing a recap. I'm not starting the topic afresh. I'm pretty sure that we did this extensively last week. Why I don't want to throw away your question. I'm also mindful of the fact that I'm also being mindful of the time we have to deal with this. Is that clear, sir? So, along the line, I'm explaining this. Because I'm pretty sure we spent 2.5 hours dealing with this last week. All right, so I don't overflow that. Maybe in the course of solving question, we look at it. So, why should a company bother about its level of gearing? This is what theories of capital structure try to explain. Why should we bother about our extent of borrowing? This is because your level of borrowing will have impacts on your cost of capital. your level of borrowing will have impact on your cost of capital. Your cost of capital will have impact on your corporate value. And the objective of a company is to maximize the value of the organization. That means companies must understand the extent to which it must borrow money or it must borrow money. Company must know the extent of debt finance it must utilize in its capital structure. This question was first addressed by the traditional school that says companies should take advantage of debt finance. Why is debt finance? If you utilize debt finance, you are going to take advantage of tax relief. The tax relief on interest payable will be used to reduce your cost of borrowing. Hence, however, it will get to a point. The more a company borrows money, it will get to a point the company financial risk will be so high. And lenders will now be giving the company loans at higher rates. What the traditional school is saying that once there's an optimal level of capital structure that companies should try to achieve. And once this optimal level is achieved, the weighted average cost of capital will be at the minimum point. And the WACC will be at the maximum point. So the value of the company will be at the maximum point. At an optimal level, the weighted average cost of capital is minimized. At that point, the total value of the company is maximized. Once the optimal level is identified, companies should maintain that optimal level. Once the optimal level is achieved, companies should maintain the optimal level. That is the position of the traditional school, which implies that the choice of capital structure decision will have impact on the value of the company. We now look at the alternative theory, Modigliani and Miller, ignoring corporate taxation. Modigliani and Miller says, in as much as there is no taxation, then capital structure decision is not relevant to market value. In as much as there is no taxation, then capital structure decision is not relevant to company's market value. That was the first argument. Later, MML revised their theory to include corporate taxation. With corporate taxation, MMM changed their conclusion that if there is corporate tax, then it is advantageous to finance your business with debt. Hence, the value of a geared company will be higher than the value of an ungeared company, because the geared company will take advantage of cheaper debt finance. So they concluded that companies should utilize debt finance as much as practicable. That was the discussion last week. And obviously last week, after the discussion, we couldn't accommodate questions. So in the course of solving questions, I will try to explain, shed more light on equity beta, asset beta, and debt beta. Because you cannot write any SFM without this being texted, either theoretically or in calculation. And the truth is, you can only talk of calculation if you understand the theoretical backing. You can only be talking of computation if you understand the theoretical principles of that particular question. All right. Tonight we shall look at, or we shall start with question number 2. Please refer to page 149, 150. Your study part. Let us look at question on illustration 2. Please refer to page 149/150. Question number 2. Please, can somebody confirm the page or reconfirm the page?
Yes, you are correct, sir.
All right, Ibrahim. Tosin.
Yes, sir.
Let's move to this business. The finance director of Cooper PSC is concerned about the impact of capital structure on the company's value and wishes to investigate the effects of different capital structures. Look at paragraph 1. Examiner gave us an indication. The finance director of this company is concerned about the impact of capital structure on the company's value and wishes to investigate the effects of different capital structure. He is aware that as gearing increases, the required return on equity will also increase. and the company's interest cover is likely to decrease. Let us explain that briefly. As a company borrows more money, the level of gearing will increase. As your level of borrowing increases, that means your financial risk will increase. Increase in financial risk, the shareholders will demand additional returns. Increase in your financial risk, your interest cover ratio will fall. A decrease in interest cover ratio could lead to a change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely. Look at it. Interest cover ratio, credit rating, cost of long-term debt. Now let's explain this table. If your interest cover ratio is more than 6.5, your company will be rated AA. And your cost of debt will be 8%. If the interest cover ratio is between 4 to 6.5, the company will be rated A. The cost of debt is 9%. If the interest cover ratio is 1.5 to 4.7, the company will be rated BB. Cost of long-term debt, 11%. The company is currently rated A. Please note that sentence. If the company is currently rated A, that means the company's cost of debt is 9%. Next. Summarized financial data. We have the operating income, depreciation, earnings, rental and tax. We have the interest expense, taxable income. The tax rate is 30%. Additional information. Market value of equity, 458 million. Market value of debt, 305 million. Coupler's equity beta, 1.4. The beta of debt may be assumed to be 0. The risk-free rate is 5.5%. The market return 14%. The company's growth rate of cash flow may be assumed to be constant and to be unaffected by any change in capital structure. In this question, we have equity beta of 1.4. What is the meaning of equity beta? What is the implication of 1.4? We have debt beta of 0. What is the meaning of debt beta? Your equity beta is an index that measures the market risk of a company. An index that measures the market risk of a company by considering both the business risk and the financial risk. Equity beta, an index that measures the market risk of a company by considering both the business risk and the financial risk. This equity beta of 1.4 includes business risk as well as financial risk. Let me explain the explanation. This equity beta of 1.4 is greater than 1. Your beta may be 1, less than 1, or greater than 1. If the beta is greater than 1, it means that company risk is higher than the market risk. It means the company shares, the risk of the company shares is higher than the risk of the markets. If the beta is less than 1, it means the risk of the company shares is less than the market risk. To 1, it means the risk of the company shares is equal to the risk of the markets. So if you are looking at equity beta, index that combine both the business risk and the financial risk. If you are looking at asset beta, an index that measures the market risk of a company by considering only the business risk. It only considers the business risk. All right. As we go more, we can shed more light on this. Now look at requirement A. Determine the likely effects on the company's cost of capital. and corporate value structure was 1. 80% equity, 20% debt by market value. 40% equity, 60% debt. Capital structure should be selected. Any change in capital structure with existing equity or by issuing additional equity to redeem existing debt as appropriate. The current total firm value, in brackets, market value of equity plus market value of debt, is consistent with the growth model. Cash flow in year 1 divided by K minus G, applied on a corporate basis. CF1 is next year free cash flow. K is the weighted average cost of capital. G is the expected growth rate. Company free cash flow may be estimated using earnings before interest and tax into bracket 1 minus tax plus depreciation minus capital spending. States clearly any other assumptions that you make. This was texted ACCA question. The requirement is very clear. The likely effect on the company's cost of capital and corporate value is 10% equity, 20% debt, or 40% equity, 60% debt. How do we approach this question? How can we start this question? For some students, how to even start the question is a challenge. I want to know the effect on cost of capital. That means I must compute cost of capital. I want to know the effect on corporate value. That means I must compute corporate value. To start the question, first, for me to know the effects, I will now ask myself, currently, what is the company's capital structure? Before the company changed to 80% equity, 20% debt, what is the company's current capital structure? If I'm done with that, I will now say, okay, what is the company's current cost of capital? Then what is the company's current corporate value? For me to talk of the likely effect of change, I want to know the current position. Please, as much as possible. We are going to try to be able to interpret questions. Elizabeth, we are waiting for you.
Sir, please, your network is breaking. Like, I hardly get a full sentence. Sir.
There is a complaint of network breaking. Please, can somebody confirm this?
Yes, sir. The network is breaking.
Yes, it's true. The
I
network
confirm that, sir.
That's a major challenge. Okay, let me see if I can. That's a major challenge. Let me see if I can switch.
Yes, sir, we can hear you.
Yes, sir, we can hear you.
Okay. Now let's go to the question. I try to switch to another network. Let's see how it goes. So our start. Look at working one. Determine the company's existing capital structure, gearing ratio, cost of equity, and weighted average cost of capital. What is the company's existing capital structure? If you look at the additional notes, market value of equity, 458 million, and of debt, 305 million. The capital structure, market value of equity, 458. Market value of debt, 305. Please sum. What is the total value of the company? Summation, please.
763. 63.
3. Thank you. Now let's take it to percentage. If you want to get percentage,
60%.
yeah, let's show it. Tosin, let's show it.
Wait.
Let's show the workings. If you now want to take it to percentage, equity 458 over total value 763. Equity is 60%. Debt debt. Let's show it. Because some may not be in class and they watch the video later. Debt 305 over total value multiplied by 140%. That means currently the company's capital structure is 60% equity, 40% debt. Currently, the company's capital structure. The company is financed by 60% equity, 40% debt. This is the company's existing capital structure. We have resolved part of the problem. Now, what is the company's cost of equity currently? From your knowledge, cost of knowledge of cost of capital calculation. Cost of capital can be cost of equity can be calculated using either dividend valuation method or the CAPM method. In this question, we can only use CAPM, risk-free rates. Go to the question and tell us, what is the risk-free rate? Examiner say risk-free rate 5.5. The market return 14%. The company's equity beta 1.4. That means we can use CAPM to derive this company's cost of equity. That means we can use CAPM. Our risk-free rate is 5.5 plus 1.4 bracket return on market 14 minus the risk-free rate 5.5. Please work this out. What is the company's cost of equity currently? You can reconfirm that.
17.4.
All right. That means based on the existing capital structure, this company's cost of equity is currently 17.4%. Next. What is the company's cost of debt? Examiner said the company is currently rated A. Hence, the cost of debt is 9%. We now need to get after-tax cost of debt. Remember, cost of debt is calculated after tax. After-tax cost of debt Please, can somebody share the material? Please, before getting to the class, this information you should have asked. As soon as you are added to a group, ask for what they have done before. Cost of debt net of tax. Well, we need to calculate the WACC currently. I will now do like this. Net of tax, 9% bracket 1 minus the tax rate. Debt net of tax. If you work that out, you are going to get 6.3%. Please, can you confirm this?
Yes, sir.
Correct, sir.
We now move to the weighted average cost of capital. What is the meaning of weighted average cost of capital? Let me hear from you. I'm assuming you have done it with the second lecturer. What is the meaning of weighted average cost of capital?
Yeah, this is a capital valuation technique used when a company source of fund contains equity, combination of equity, debt, preference share with their underlying cost of capital, like dividend, interest, and all that.
All right.
Mm.
Your explanation tells me that you have done something like this. Your cost of capital, your WACC, the weighted average cost of capital. The average cost of the different types of capital used by the business. The average cost of the different types of capital used by the business. The types of capital may be equity, debt, preference shares. So I need to look for average of the cost of equity, cost of debt, cost of preference shares, and what have you. To calculate your WACC, you can use this formula. Cost of equity multiplied by value of equity, close your bracket, plus cost of debt after tax multiplied by value of debt over equity plus value of equity plus value of debt. You can use this. Our cost of equity 17.4%. Value of equity 458 million. Plus cost of debt after tax 6.3%. Multiplied by value of debt 305,000. Divided by equity 458 plus 305. Please work this out. Please work this out quickly. You are going to get 12.96. Your final answer will be 12.96%. Existing WACC. Please work this out. Alternatively, you can also calculate your WACC using percentage, using the percentage amount. Your WACC can be calculated as cost of equity multiplied by the percentage of equity. Cost of debt after tax multiplied by the percentage of debt. Our cost of equity is 17.4%. The percentage of equity is 60%, 0.6. Or you can do percentage, it doesn't matter. You can do 60%. Plus cost of debt after tax, 6.36%. Percentage of debt, 40%. Please work this out. You are still going to get WACC. WACC 12.96%. Please, I'm expecting your confirmation figure.
12%, sir.
All right. We have gotten, if you look at what we have done in summary, look at the summary of what you have done. Summary of what you have done so far. Capital structure. Capital structure. 60% equity and 40% debt. Existing cost of equity, 17.4%. Existing weighted average cost of capital, 12.96%. Existing corporate value. Your value is 763 million. Corporate value is addition of equity and debt. This is the current information about the company. The question now says, if there is change in capital structure, look at it. New capital structure now becomes 80% equity, 20% debt. If the capital structure changes to 80% equity, 20% debt, that means I need to know what is the cost of equity now. I want to know the impact of this change on cost of equity, on weighted average cost of capital, on corporate value. I want to determine the likely effect of change in capital structure on my cost of capital and on my corporate value. All right. We now start with the first one. Assuming capital structure change to 80% equity, 20% debt. Now, please, I want you to note this. Once the capital structure of a company changes, once the capital structure of a company changes, the existing equity beta is no longer valid. Our existing equity beta is 1.4. I'll repeat my points. Please, I want you to try to digest this now. Please try to digest this information. If you find yourself in the exam and you observe that the capital structure of the company has changed, it implies that the existing equity beta is no longer valid. Our equity beta of 1.4 was based on 60% equity, 40% debt. Our existing equity beta of 1.4 is based on the existing capital structure. 60% equity, 40% debt. Now that the capital structure has changed, that 1.4 is no longer valid. In that case, you are going to ungeared the existing equity beta. You are going to ungeared the existing equity beta. The purpose of ungearing, the reason for ungearing is to remove the existing capital structure, 60% equity, 40% debt. To ungear means convert the equity beta of 1.4 to asset beta. If you are converting to asset beta, that means you want to remove what? The financial risk. Asset beta is an index that measures the risk of a company by considering only the business risk. It ignores the financial risk. So if I want to convert equity beta to asset beta, what I'm trying to do is to ignore the financial risk. I want to ignore the existing financial risk. All right. So, Mr. Usman, please try to pick this now. You now state your formula for asset beta. Beta of assets is equal to beta of equity multiplied by value of equity all over value of equity plus value of debt, bracket 1 minus tax, plus beta of debt multiplied by value of debt 1 minus tax, all over value of equity plus value of debt, bracket 1 minus tax. We now come here. You can start from here. Or we come here. Our BA, beta of equity is 1.4. Value of equity, you can either use the absolute value or you can use the percentage value. You can pick 458 million or you can use 60%. You are going to get the same answer. 1.4 multiplied by 60, equity is 60, over value of equity, equity is 60, value of debt, debt was 40%, bracket 1 minus the tax rate. Plus, examiner says you can assume that the debt beta is 0. If the debt beta is 0, 0 multiplied by any figure will give us 0. That means everything here, debt beta is equal to 0. Everything here becomes 0. 0 multiplied by any figure will give us 0. Please work this out. 1.4 multiplied by 60. What do you have? Oh yeah.
$84. 84, sir.
84. Our BA is equal to 84 over
88.
88. Please work this out. Final answer 0.95. You observe that the value has reduced. You have removed the financial risk. We are now left with the business risk. Asset beta only considers business risk. Next, we now introduce the new capital structures. If gearing was 80% equity, 20% debt, the asset beta may be the new asset, the new equity beta. When we say re-gauge, convert asset beta to equity beta using the new capital structure. Look at it. Beta of equity is equal to beta of debt 0.95 plus bracket beta of debt 0.95 beta of assets, sorry, minus beta of debt. Debt beta is 0. Value of debt now. Debt is now 20%. Equity is now 80%. This is the new capital structure. Brackets 1 minus the tax rates. Please work this out. Please apply your calculator. And somebody should give us the final figure. (20/80). That will give me 0.25, 0.7. Yeah. What is our B? Is anybody speaking? Elizabeth, are you trying to say something? 1.1 what?
1.11. Okay, 1.12.
1.12. You have now gotten a new equity beta based on the new capital structure. I repeat my point again. Question of this nature will be in your exam. Regeared, ungeared is an aspect of financial management. Both at the skills level or the professional level, ICAN will text something that will take you to this process. You can now get cost of equity. The new cost of equity now. Cost of equity is equal to RUF. RUF will not change. The beta now, the equity beta based on the new capital structure is now 1.12. Return on market will not change. Minus 5.5. Please, what is the cost of equity now? Please reconfirm. Ooh. Please reconfirm. Oh yeah.
It's
You are
correct,
correct,
sir.
sir.
I just want you guys to be part of the calculations. We have gotten the cost of equity based on 80% equity, 20% debt. Next. If gain was 40% equity, 60% debt by market value, that is scenario 2 now. Again, we now regeared the asset beta. That asset beta, 0.95. That asset beta represents the business risk. That will not change. The business risk of this company. We now want to regear using the new financial structure. Now come here. Beta of equity is equal to beta of assets plus bracket beta of assets minus beta of debt, value of debt over value of equity, 1 minus the tax rate. The beta of equity, beta of assets, 0.95 plus beta of asset, 0.95. Beta of debt, 0. Value of debt now. Debt is now 60%. Equity is 40%. 60 over 40. Bracket 1 minus the tax rate. We have 0.95 plus 0.95 bracket 1.5. 60 divided by 41.5 bracket 0.7. Please work this out. You should have 1.95. Please work this out.
Yes, 1.95.
You observe that based on the second capital structure, it has changed again. Now let us calculate cost of equity for the second capital structure. 40% equity, 60% debt. Cost of equity is equal to RF 5.5 plus beta is now 1.95. Return on market 14 minus 5.5. Please, what is the cost of equity now? $22.08. Please reconfirm.
Correct, sir.
Right, sir.
You can begin to look at the impact of changes. We have looked at the impact of these changes on cost of equity. If you look at it, if debt is reduced to 20%, cost of equity will also reduce. If debt is increased to 60%, cost of debt will also increase. So the cost of equity will also increase. This is in line with the principle As gearing increases, as the company borrows more money, equity shareholders will demand additional returns. Hence, cost of equity will rise. As gearing reduces, financial risk will reduce. Hence, cost of equity will reduce. Return to shareholders will reduce. We have tested cost of equity. We now need to look at cost of debt. Then we now go to one. The current cost of debt is 9%. That is, at the current capital structure, 60% equity, 40% debt. The company is rated A. Cost of debt is 9%. Now, I want to know what will be the cost of debt if capital structure changes to 80% equity, 20% debt. Debt has reduced now from 40% debt to 20% debt. What will be the impact on cost of debt? We now work this out. Remember that in this question, examiner says what determines cost of debt is your credit rating. What determines your credit rating is your interest cover ratio. I'll take that again. In this question, the examiner says what determines the cost of debt is a function of your credit rating. What determines your rating is your interest cover ratio. That means I need to calculate the interest cover ratio at the new capital structures. I will not come in. Look at this working here. Debt is now 20%. That means 20% of total value. 763 million. What is the value of debt now? 152 point something. Is it 0.8? I'm not sure.
It's 0.6.
0.6, thank you. That means if I want to convert that percentage to value, the debt will worth 152.6 million now. I can look at approximate new value of debt. Debt is now 152.6. For the second scenario, 60% debt. That means this is scenario 1, scenario 2. 60% debt. Please compute. Oh. 60% of 763 million. Forward.
457.8.
457.8.
That means the debt here now is 457.8. Assuming our interest rate still remain 9%. Assuming currently our interest rate is 9%. Currently the interest rate is 9%. Assuming the interest rate remain 9%, then what is the interest payable here? 9% of 152.6. What is the interest payable? $13.9% of 152.6. What is the interest payable? 13 point what?
Which interest, sir?
Okay, I said, assuming the interest rate still remain 9%, and our debt is 152.6. What is the interest rate payable? That becomes 9% of 13 point what?
77.
Or 13.8.
13.71.
3. It should be 13.73 now.
Everybody having different answer. Why now?
13.7.
13.71.
Which one are we going to take now?
It's
Somebody say
13.73 now.
13.73.
73.
13.73.
Okay, 13.73.
13.73.
$13.73. What we did is to compute 9% of the new debt. Assuming we come here, 9% of the new debt, 41 point what?
41.2.
41.2. Now, what is our earnings before interest and tax? If you look at the statement, 90 million. 90 million. Let's go and look at it together. Earnings before interest and tax is 90. Now, let me quickly add this. Your profit before interest and tax will not be affected by change in your capital structure. Operating profits is not affected by change in capital structure. Please note it down somewhere. Earnings before interest and tax is not affected by change in capital structure. You can now compute interest cover ratio. Your interest cover ratio is earnings before interest and tax divided by the interest. 90 divided by 13.73. What do you have? 6.55.
6.55.
Next, 90 divided by 41.2. 2.18. Now let's go and check. If the price and if the interest cover ratio is 6.55, what is the company's credit rating? We want to know the credit rating. Look at it. Interest cover more than 6.5. The company is rated what? AA.
A.
AA.
Okay.
What is the cost of debt?
8%.
Alternatively, if the company's interest cover ratio is 2.18, that will 4 years. The company is rated what?
BB.
Cost of debt is what?
11.
The purpose of your calculation is to determine the rating, the credit rating. The credit rating will now guide you to the cost of debt. The purpose of the calculation is to determine our credit rating. The credit rating will now guide us to the cost of debt. Here, the rating is 8%. Here, the rating is BB. Cost of debt is 11%. You can now calculate after tax. After tax cost of debt. This one becomes 8 bracket 1 minus tax. This is 11 bracket 1 minus tax. What this are, what do you have? What is the after tax cost of debt? Cost of debt after tax. What do I have here? 5 points.
5.6.
5.6. 7.7. Why are we calculating after tax? Is because you need to compute your WACC. WACC at the new capital structure. What is WACC here? The weighted average cost of capital at 80% equity, 20% debt. Put in your formula. Cost of equity multiplied by percentage of equity plus bracket cost of debt after tax multiplied by the percentage of debt. Cost of equity, if you recall, At 80% equity, 20% debt. Cost of equity 15.02%. Percentage of equity now 80%. Plus cost of debt under this scenario 5.6%. Percentage of debt now 20. Please work this out. What is the WACC? What is the WACC? $13 what?
13.1.
14. $13.14. Again, WACC at 40% equity, 60% debt. Take your formula again. Cost of equity multiplied by percentage of equity plus cost of debt after tax multiplied by percentage of debt. At 40% equity, 60% debt. Cost of equity 22.08 multiplied by 40% equity plus cost of debt now 7.7% multiplied by 60% debt. Please, what is the WACC? 30.4 was. Let me reconfirm. Mr. Usman, I hope you are fine.
Times 6. 13.45.
45, all right. It's an approximation. That's fine. 13.45. Any questions so far? Any questions so far? If you look at it now, we have gotten cost of equity at the new capital structure. We have gotten WACC. Your WACC represents cost of capital. The weighted average cost of capital at the new capital structures. The question says, determine the likely effects on company's cost of capital and corporate value if the capital structure was 80% equity, 20% debt, 40% equity, 60% debt. You have looked at the impact on cost of capital. We now need to look at the corporate value. What is the impact of this change? This is what the traditional theory is saying. The traditional theory says that Capital structure decision will have impact on the company's value. How you choose to finance your business will affect your value. How you choose to finance your business will affect your cost of capital. Have you seen it now? When we finance with 60% equity, 40% debt, our cost of capital was 12.96. When we change to 80% equity, 20% debt, our cost of capital becomes 13.14. When we change to 40% equity, 60% debt, our cost of capital becomes 13.45%. Please note what represents cost of capital. You can see that capital structure decision have impact on the cost of capital. This is the position of the traditional school. That how you choose to finance your business will have impact on your value. We now want to look at the impact on corporate value. We have gotten the impact on cost of capital. What is the impact of this change on the corporate value of this company? Please don't be surprised if something like this is given to you as 30 mark in your exam. Do not be surprised if a question like this is produced as number one question in your exam. So, how do we determine corporate value now? How can we determine corporate value? The examiner gave us a clue on how to get corporate value. The examiner gave a clue on how to get corporate value. Let us refer to the question. Now look at the notes. Any change in capital structure will be achieved by borrowing to repurchase existing share, existing equity, or by issuing additional equity to redeem existing debt as appropriate. The current total terms value, bracket open, value of equity plus market value of debt is consistent with the growth model. Let us look at the growth model. Examiner say, look at the growth model. Value is equal to cash flow in year one over K minus G applied on corporate basis. CF1 is next year free cash flow Letter K represents weighted average cost of capital. Letter G represents the expected growth rate. That means I can calculate value now. I'll pick cash flow, the free cash flow. I'll pick my WACC, and I'm going to get my what? My growth rate. Examiner gave a clue. Look at it here. Company's free cash flow may be estimated as earnings before interest and tax into bracket 1 minus tax plus depreciation minus capital spending. The examiner gave you the secrets to the calculation. Go and get free cash flow. You have computed WACC. You have calculated WACC. Go and get your free cash flow and get your growth rate. Examiner says, look at it here. The company's growth rate of cash flows may be assumed to be constant and to be unaffected by any change in capital structure. That means if I know the current growth rates, I can use it because the growth rate will not change. Okay? We now return here. Look at the comment. The two are expected to increase the cost of capital from its current level. That is correct. Corporate value, cash flow in year 1 over K minus G. This can be restated as, please look at this. You can restate this as, you can do like this. Value is cash flow now, bracket, oh no, let me take this away. It won't take it here. Value can be restated as, got it, value cash flow now, bracket 1 plus G over K minus G. And we are told that cash flow, if I want to know the current cash flow now, as of today, earnings before interest and tax, my cash flow is equal to earnings before interest and tax, that is 90, bracket 1 minus tax, 0.3, plus depreciation, 20 million, minus capital spending, 20 million. Please, what is the current free cash flow? Work this out. You are going to get 63 million. This is the free cash flow now. Next, the growth rate. We don't know the growth rate yet, but we know the corporate value existing. Value is equal to cash flow bracket 1 plus G over K minus G. The existing value is 763 equal cash flow now 63 bracket 1 plus G. I don't know G. Currently, our WACC is 12.96. Our WACC 0.1296 minus the growth rate. What we are trying to achieve is, what is the growth rate? That growth rate that will not change. We know the value now. We know the cash flow now. That is based on the existing capital structure. 60% equity, 40% debt. Value is currently 763 million. Cash flow is currently 63 million. WACC is currently 12.96%. Given these variables, I can determine, we can estimate what is the growth rate. We can cross multiply. 763 bracket 0.1296 minus G is equal to 63 bracket 1 plus G. For convenience, divide both sides by 63. You are going to have 763 bracket 0.1296 minus G divided by 63 is equal to 63 bracket 1 plus G divided by 63. This will trash out this. Divide 763 divided by 63. 12.1 here I have 12.1 12.1 bracket 0.1296 minus G is equal to 1 plus G. You can open the bracket now. 12.1 multiplied by 0.1296. Here you have 1.568 minus 12.1 G is equal to 1 plus G. Collect like terms. This will come like this. 1.568 minus 1 is equal to G plus 12.1 G. 0.568 is equal to 13.1 G. What is G? G is equal to 0.568 divided by 13.1. Divide this by 13.1. By my answer here, what I will have here is 1.570 if I approximate. What I have finally is 0.043. If you convert to percentage, the growth rate is 4.3%. We need to get that growth rate that is expected to remain unchanged. We can now calculate value. Value based on 80% equity, 20% debt. Corporate value is equal to value is equal to cash flow bracket 1 plus G all over K minus G. This is equal to cash flow 63, 1 plus the growth rate 0.043. (0.043) divided by K WACC. What is the WACC? At 80% equity, 20% debt, the WACC is 13.14. 13.14%, 0.1314 minus the growth rate. The growth rate is 0.043. Please work this out. What is the value of the company now? If equity is 80%, debt is 40%. What is the value of the company? If equity is 80% and debt is 40%.
I got 743. Is it correct?
Corporate value becomes what now? I think it should be correct.
Oh, okay. 743.3.
74. Yeah. Value now become 743 million. Value is equal to 743.3, Abby.
Yes, sir.
Now, next, what is corporate value? If equity is 40, debt is 60%. Again, state your formula. Value is equal to cash flow, year 0, bracket 1 plus G over K minus G. Value is 63, 1 plus the growth rate divided by, what is WACC? If equity is 40%, debt is 60%,
13.45.
0.145 minus the growth rate 0.043. Why am I doing this now? We know the growth rate now. 0.043. Please work this out. What is corporate value? $717 or 8?
718.
718. We can now make a recommendation and draw a conclusion. We can make recommendation and also draw what conclusion. You are going to tell me your recommendation now. The information will be presented to your doorstep. We have capital structure, please, I'm going to try to, because of space, I might probably shorten this. I don't like doing that, but because of space, okay, we have 60% equity and 40% debt. We also have 80% equity, 40%, no, 20% debt, debt. We now have, this is existing, new, 1. We have new, 2. We have 40% equity, 60% debt. Cost of equity here, 17.4. 15.02, 22.08%. WACC, in bracket, cost of capital, 12.96, 13.14, 13.45. Corporate value. Here we have 763 million, 743, 781. Which of these capital structure will you recommend for the company and why? The question is to the class. It's February rain. It's about raining. I can hardly hear you, man. Hello.
Don't know.
Sir, good evening, sir.
Yes, I can hear you telling.
Based on my understanding, I will at least recommend the existing because it gives higher corporate value than any of the new ones. And also the WACC, cost of the capital, is minimum than any other one.
Perfectly correct. At the existing capital structure, 60% equity, 40% debt. The cost of capital is minimized. The weighted average cost of capital is minimized. And the total value of the company is maximized. This is the optimum level of capital structure. Any attempt to change it, we have negative impact on cost of capital and negative impact on corporate value. I'll take that again. The existing capital structure, 60% equity, 40% debt, is the optimum level of capital structure the company should maintain. At this level, the cost of capital of the company is minimized, and the total value of the company is maximized. Perfectly correct. Look at the comments here. Altering the capital structure to either of the two suggested levels is expected to reduce corporate value from its current level of 763 million. It is recommended that the capital structure is kept at its current level of 60% equity, 40% debt. You are done with requirement A. You are done with requirement A. Any question, please? Before we go to requirement B is theory, no problem. Any question for us?
Sir, I think you are experiencing quietness because there are where to even start from. It's,
Like this is just
honestly, because
a
if this exam is to take 3 hours and
We
we
spent
are
only how many
using
hours?
honestly, I don't know where I got lost from completely is that gearing and regearing. I mean, on gearing and regearing.
Let me quickly ask.
Mm.
Have you started this with the second lecturer?
Yeah, we've started. It's
Look at
just that the ocean is becoming deeper now.
If you look at it, this topic is supposed to assist cost of capital calculation. Capital structure is meant to further increase your knowledge of cost of capital. Why I'm asking this is, the one should have taken you through project specific cost of capital. When you are going to ungeared and regeared. So have you done that?
I think that is the next place we are going in the next class.
We haven't.
So
We have not.
We have it tomorrow.
Yes.
Tomorrow.
we are starting it tomorrow.
So I can understand to some extent that which one are we going to even ourselves? Because at a point, some are lost. But what we expect is after like 2-3 classes with Mr. Juwon, we expect the knowledge to get better. So if you can't pick 100% now, don't close your minds to the topic. Try to be part of subsequent classes for Mr. Juwon, because you are likely to have it in your exam. And for everybody writing the exam, the objective is to pass. So you are going to make that sacrifice. What we have discussed tonight, tomorrow class, if you are doing your project specific course, you are going to ungeared and regeared. You are going to have equity beta and asset beta. So hopefully the knowledge will now get clearer to the students. That is the best I could do now. Also, the side comments. Out of 3 hours, we have used almost 2 hours for one question. That comment is is just a classroom comment. In exam, in your exam, you are not going to be explained to anybody. So your focus will just be yourself. So please, let's try to come back to the video and look at the question deeply. All right, the last aspect, let us round up. Examiner says, discuss possible reasons for errors in the estimate of corporate value. The corporate value we have calculated can contain errors. Why? Estimate of corporate value are only approximations. We have calculated an approximated value and may contain or may be incorrect for many reasons. What are these reasons? One, the assumption of constant growth rates may be incorrect. We assume that the growth rates will remain constant forever. In reality, growth rate may change. Number two reasons. The corporate value in this model is sensitive to capital spending, which might alter considerably from period to period. Capital spending might change. In this question, it is assumed that capital spending is constant. Number three, the model ignores the cash flow impact of any changes in working capital. If there is changes in working capital, in the question we have calculated, we completely ignore working capital changes. Number 4 or 5. Any changes in gearing will involve transaction costs as shares were repurchased or issued and debt was issued or redeemed. Change in capital structure will involve transaction costs. In this question, we have ignored transaction costs. Number next, repurchases of shares might not be possible at the current market price. Next, corporate tax might change, and that will affect our valuation. Number next. Credit rating agencies use other factors in addition to interest cover ratio. For this question, we have only used interest cover ratio to determine the credit rating. But in reality, several other factors will be used to determine credit rating. We have assumed that debt beta is 0, but corporate debt is not risk-free. It's not 0. We have done enough. Any question, clarification? All right. We shall be calling it a good night.
Only that we need a video to go
May
over
God
it
give
again, sir.
us a better understanding. God bless the little we have done. Good night.
And good night, sir.
Thank you, sir.
I'll be checking out.